Good afternoon. You're watching Closing Trades right here on ET Now, and it's not really turning out to be a good afternoon by any means. We've broken that 17,300 print on the index, sub the 17,200 mark right now. We're at the lowest point in the day, 220 points lower for the Nifty spot as we speak right now, and 1.5% gone for the Nifty futures as well. All sectors are really getting clobbered. You know, if you were to really draw down the list of winners, it's only one Tech M. Besides that, at best, there is a little bit of resilience within Adani Enterprises or in Apollo Hospitals or ONGC to some degree. But look at Mphasis, look at ICICI Bank, look at what Reliance is up to and what HDFC and HDFC Bank are up to, because they are alone contributing to over 100-point fall in the Nifty. So they are the ones which are really weighing heavy on the indexes as we speak right now. Nifty Metals is in the green with just about marginal gains. Banks, of course, like I said, have dragged the most, and Nifty Auto as well has been seeing the third consecutive day of a fall. Look at what's happening with an M&M right now. It's struggling around that 1100 odd level right now. Tata Motors is sharply lower by about 3.5%. Kunal, there's no way to sugarcoat what's happening today.
Well, absolutely not. And I think we've broken below the major important supports from both indices, Nifty as well as Bank Nifty, and that is a point of concern for the markets now. And you know, so the fact that over the last 2 or 3 months we were holding on to this very, very important support, and on such a kind of a day we've managed to break below those strong support points, indicates that we've opened the floor for the index on the downside. Now what we'd be looking out for is two important technical points. One is on the Nifty, we would now be looking out for at least a 600 to 800 point range which we were trading on, from 17,200 to 17,800 broadly. So that 600 to 800 points would probably be shifted downside, so which means 16,500ish is where we would probably look out for the next targets for the Nifty. And for the Bank Nifty, that range is almost 2,000 to 2,500 points. So if we try and look out for Bank Nifty, then we could be looking at 37,500 to 38,000 on the Bank Nifty.
But I wonder why, considering now HSBC has bought over SVB Bank. So I don't know why this kind of collapse, what you're seeing. And by the way, it's not just us. Look at how Europe has started off in trade. About 1.5% is the kind of cut that you're seeing across the board. DAX is down over 200 points right now. Almost a 100-point fall coming in the FTSE. CAC down 100 points. You know, it's almost like wonder what the fear, fear on the street is now.
So, well, what HSBC has bought is the UCO operation. That's not even 20% of the total operation. That's one. So that's just the headline understanding. Asian markets have closed in the green. When we walked into this morning, there was no problem whatsoever. It all appeared that the US contagion effect was calmed. Interestingly, that while we talk right now, I just saw like 30 seconds ago, US futures are trading in the green. So if US is the epicenter of all the problem, then US futures, guess what, guys, are trading in the green. Despite the fact that there is a rub of green for US futures, other markets are down, which means, is this an indication that the reaction in other markets is slightly more technical and sentimental driven? I think yes, because if the problem is in a bank in US, and if the US financial system should have reacted the first, but US markets off from the day's high, but it's a steady state of green, 0.5% up for S&P, 1% up for NASDAQ, almost a break-even kind of a number for Dow Jones. So what is leading to this decline? And the decline, I guess, Aisha, is very universal in nature. It is not restricted to just banks. It is defensives, IT, you would imagine autos. Very domestic looking markets are looking weak. I think that the selling today must have got triggered because of a large institutional selling that has broken the back of the Nifty. Up until now, we've been using the word range for this market, which is lower end of the range, market is finding support. At the upper end of the range, the market is finding resistance. Today, the range has been decisively broken. And when a range of a market which has been steady has been broken, it's just an indication of supply more than fundamental factors. Look at Adani group of stocks. Isn't it ironical? The problem started with Adani group of stocks, and today Adani group of stocks, almost all of them are trading with the positive bias. So Adani group of stocks are in green. Dow futures are in green.
Actually, no, Nikunj, they've slipped quite a fair bit. Okay. In fact, now they've slipped in the red, the Dow futures. I'm just going to quickly bring them up on our screens. What you're seeing on your screen is a bit of a delayed feed. But now they've slipped into the red, and they've given up all of their morning gains, because when we came into trade, the Dow futures were much higher. From there, they've completely wiped up all of their gains. But Dinesh, as a strategy, given that we've breached some key levels today, what is it that you're doing in terms of stock-specific trades? Naresh?
So overall, the view is we've broken the levels on the Nifty, and now is the time where you just need to wait it out. Wait for that 16,800 to 17,100 band slowly to come there. As below 17,100 to 16,900 is where I would like to accumulate. The last low is around that 16,800 mark at that 16,750, 16,800. So want to be buying as closer to 17,100 to 16,900 band and get an average towards 17,000 and keep a 200 pointer stop loss and go long. This could well be the place where we could see a short term bounce from. We are getting into oversold territory, RSI positive divergences, and what we are seeing is this could be a leg wherein this could continue for the next few sessions, given that the next event is on 23rd March, which is the Fed rate hike 122nd, and we see the impact on 23rd. So over the next 1 week, roughly, we should get that opportunity closer to that band. So a short-term breakdown is done, but I don't expect it to take it very sharply down.
Mahantesh joins us now. Let's connect with him. Let's take our conversation forward. Mahantesh, what has triggered the sell-off? I mean, if the problem was that what's happening to the US financial system, well, there is a bailout which has happened there, and it's a decent bailout where depositors have been taken care of. So then what is injecting this nervousness?
So I think the nervousness is born of the fact that this is not the only bank, or we have also had another bank that is going down, Signature Bank. But these trouble is not merely limited only to two banks. It appears now that most banks will see their treasury book, at least their investment book, downsize quite considerably, and there will be following events that will catch up with them. Such things as there will be depositors pulling out their money. There will be a general rout in the bond market. So the overall banking situation within the US seems to be right now quite weak, despite the interventions that we are seeing from the regulator. Having said that, one has to properly answer. Finally, we were all worried about inflation. We were all worried about where the Fed rate hikes gonna end, and how is the Fed's balance sheet gonna come down. I think all that progress is still happening on an incremental basis. Inflation is ticking down. Fed's balance sheet has already started to come off, and we are seeing that the Fed will somewhere end the rate hikes this year. Now, if that is the case, then I see these events that are now engulfing the U.S. Markets, particularly the U.S. banking system, quite temporary in nature.
Just now, Jayabala, thank you for joining us. What is your understanding of today's market setup? I mean, how bad it could get? Do you think bad could get worse, terrible, ugly before it stabilizes?
Thanks for having me on the show, Nikunj. Yeah, this market is just entering the accelerator phase of the decline. So, that's going to be a point of recognition for many investors. That will be around 16,750, which is the September low. Once that's broken, only then people will start realizing what I've been saying for several months. And the context, as I said in my first line, is that this is entering the accelerator decline phase. So we got much more to work with on the downside.
I think Jay is going to actually lead this downfall, because what we are seeing today is, a mix of Reliance along with Mphasis, ICICI Bank and the HDFC twins, which are actually contributing to almost a 100-point fall on the index alone.
Yeah, see, banks are entering one of the short-term breakdown point. It's been in a 5,000 point range, and I had said last time that don't be misled by the lack of break of the budget day low. And today we have the markets, the banking index coming close to it, and Reliance is having a fresh breakdown below the February low. The February low was 2290. So we're going to have Reliance, banks, and IT. IT is on tenterhooks, and Nifty IT it can't afford to go much below from where it is right now. So there are multiple sectors which are trying to see a fresh break. 29,300 was an important level, and as I see now, the IT index is 29,200. So, multiple sectors are breaking down at this point. So if we have a close at these levels, we have it could be that Reliance, banks, and IT could be leading the way down.
A strategy, Jayabala, for those who are watching the show: cut out of all long positions, compulsory, take a hit and get out.
Yeah, and not only that, that's definitely a strategy. Use any relief rallies. If Nifty were to, there is a small probability that Nifty could bounce back to somewhere close to 17,600. If that were to come to, even use that to exit. And raising cash is a very important strategy that one can adopt. And probably, if you can afford, move to some dollar investments. Probably, dollar is probably going to strengthen later on.
Well, I really appreciate your time. Thank you for joining us. Interestingly, the dollar index today has gone from 105, which it touched a couple of days ago, to 103. Now, you can argue back and say that, okay, when the prices problem happened in 2008, money moved back into the dollar index because the world was running scared. But that time, the emerging market debt levels were very different. So there is a fundamental difference in what happened in 2008 and now. Leverage, positioning of the world, interest rates, macro, and the emerging market balance sheets for at least countries like India, which is in a much more superior phase. Nuresh, what should be a strategy for someone who's watching the show? Just get out of long positions. Don't be greedy here. Don't stick to. Bite the bullet, eat the bitter pill, take a stop loss.
In terms of the index, the stop losses got hit on Friday itself, and now if you've taken a recent buy today, you got stopped out at 17,300. So if you've not taken a stop loss till now, then there is some issue in terms of the trading style. Either you are a very long-term investor or something. As a trader, a lot of stop losses have been hit. If you're a really positional trader, it's a different case. Or your stocks are very different. So this is a market which is very similar to 2015-16. We continue to be in a range of 12 to 15 months. Like right now, we topped out in 2021 in the end of it. We are in 2023 now, very similar time frame. And say in that sideways period, the small cap index did pretty fine. It was sideways relatively, did not fall off much more than the index. We've seen a lot of sectors do well. So even today, if you look at it, we are seeing sectors do well. So there is a PSU index, which is just 2% away from an all-time high. The capital good stocks have gone up 50 to 100%. So there has been a lot of selective moves over the last 1 year, wherein there were multiple places one could have made money. So the same view continues. We are not going down swiftly towards say a 15,500 mark or 16,000, somewhere closer to 16,800 to 70,000, which I expect to be touched, and that is the zone we should expect a short-term bounce from, and then review. So right now is the time to just stay out, wait for the dip to continue. So either you want a further dip to buy or wait for a major reversal back above 17,400 levels.
Okay. You know what? We're going to take a very quick break. We're falling thick and fast. In fact, we're now down 270 points in the Nifty futures. 17,182 is where we're currently at, and sub that 17,150 print for the Nifty spot. So it doesn't seem like the selling is quite done. 270 points lower as we speak right now for the Nifty spot. IndusInd Bank has now fallen almost 8%. Piramal Enterprises is down 5.5%. And these are specific stocks where you are seeing fresh shorting. AU Bank down 5.5% now. L&T Finance down 5% nearly. And Indiabulls Housing as well, which is down 4.8% on the futures alone. We'll take a very quick break, come right back. We'll continue tracking the market fall. Back with closing trades right here on ET Now. Closing trades not looking all that peaceful. We're now on the brink of breaching 17,200 once again for the Nifty futures, sub that level and way sub that level for the Nifty spot. In any case, 17,150 is where we're currently at. But that one lone star which is actually holding out, that's Tech Mahindra. Let me take it across to Kunal and find out what he's really making of this particular stock and this big move that we've seen today. Kunal?
Thank you, Aisha, for that. So, we're doing a 3D analysis for Tech Mahindra. By 3D, I mean three-dimensional analysis, where I've taken 3 different time frames just to try and extrapolate that how the charts have been shaping up over the long term, as well as coming to the very short term kind of a view. Now, this is the charts for Tech Mahindra on the quarterly time frame, spanned over the last 15-16 years for the stock. And you can look at the classical way the stock is going into an upward trend, holding on to the resistance lines on every major periods where the stock has gone into a euphoric uptrend mode and then falling onto the sharp corrective phases in between. So right now the stock is into this phase of correction. The correction seems to have ended for Tech Mahindra, and in fact the corrections have also been more of a Fibonacci related corrections, where the stock has come back towards almost a 61.8 retracement, a correction which stalled at the 900 mark for Tech Mahindra. Then we look out for the slightly shorter term time scale, which is on the monthly charts. And one of the very important trend indicators which have given signs of or nearing signs of a breakout is this trend indicator. And when the trend indicator nears this breakout, this zero barrier, that's where you see the stock going into a multi-month uptrend. This was seen in 2020-21 for Tech Mahindra, 2022 for the stock, and very recently we are now coming very close towards the breakout of this zero barrier for Tech Mahindra. And the third charts would also be very interesting because it tells you how the last 2 or 3 months the stock has been consolidating in a tight range. So this is almost a 250 point band for Tech Mahindra, from 900 as a base to 1150 as a resistance. You can see the jump in volumes. This is a major spike for Tech Mahindra in terms of volumes, where we spotted the stock at 1050 levels, went up to 1150, came back towards 1050, and now given a breakout. So now on confirmation of this breakout, we could be looking at a 250 point upside for Tech Mahindra from that 1150 mark. So 1400 could be an immediate target for the end of the year for the stock, and beyond that we could be looking at the stock extending the long-term uptrend.
Right. Okay. That's Tech Mahindra, clearly emerging as the dark horse of 2023. But, just looking at the prospects of not just Tech Mahindra, but look at what, on the other hand, Infy is up to. An ouster from Infy, and in addition to Tech Mahindra stable because of the new appointee, that's how soured the sentiment is across the rest of the IT pack. But Mahantesh, just wanted to, get your views on whether you think, Tech Mahindra may emerge now with an Infy old hand as the dark horse perhaps for the year ahead within the IT gamut.
Yeah, they can potentially emerge as a dark horse with the new CEO in place. But Tech Mahindra has been doing fairly robust and solid business. They were troubled simply because of the EBIT margin contractions that have happened. You would have noticed that most of the IT companies were troubled by huge amount of attritions because they were looking for fresher talent on the cloud side. Now those attrition fears are going away, with the result that most of the IT companies should be able to post better incremental margins going ahead with a solid order book, which is the TCV that they have been garnering, the total contract value that they've been garnering over the years being stronger and stronger, and moving away from the traditional banking BFSI kind of sector. I believe that IT sector should be doing robustly well. They were also in a bit of a spot because of the visa issues, H1B visa issues. So all those problems I foresee for IT companies now in the back, with the result that a company like Tech Mahindra under a new fresh face can potentially do really well.
We've seen the Wipro experience, Mantesh. Everybody thought that the change of guard in Wipro will work. It worked very well for the first 2-3 quarters, but now they are in a difficult sort spot, so to speak. So I respect that what Mr. Joshi brings on the table, but turning around companies, we know that takes more than an individual.
Yeah, you're right. These sometimes what happens, these transformations that happen take a long time to really start showing up. Wipro that you mentioned, and incidentally has gone through a strategic change in the last month. Recently, they announced the clubbing of various business verticals, partly born out of the acquisitions that they had done in the past. So you will notice most of the IT companies have been now on an acquisition spree because some of the capabilities that they desired to have, particularly on the AI side, IoT side, cloud side, were not really present so much. So these acquisitions were the avenue through which they were trying to grow, and the acquisitions by themselves needed to be restructured into the organization. So that effect is something that you are seeing. I believe with these kind of restructurings in place by most IT companies, they will emerge out quite stronger. As it is, like I mentioned, attritions is not a problem anymore for them. Therefore, it's a signal that most of them should be able to garner better margins ahead, and their deal wins are pretty strong, given the acquisition background as well. So I feel most of the IT companies should be henceforth doing well. Believe they've been severely punished simply because people thought that they were too overvalued.
Naresh, it's interesting that on a day like today, when India is underperforming, Nifty is broken below key technical levels. Adani Enterprises is in the green. Adani Port is down 2%. That's a relative outperformance in my book. Adani Green and other stocks, let's look at it. These are not the scary stocks of today's market mayhem. Adani Green is circuit up. Adani Transmission, let's look at it also. Where is Adani Transmission? Just wait for it to Adani's transmission circuit up. So Mantesh, Adani group of stocks which were the weakest link on a day like today selectively are outperforming.
It's very difficult to say, at the end of the day, the macro picture is something which is being observed right now, and not really the micro picture. What I mean really by that is that most of the companies, particularly Indian large cap companies, are doing well in terms of profitability, in terms of good cash flows, in terms of generally growing their business. It's just that the macro picture is something which is causing a concern. So I believe somewhere the micro, when we start looking at individually each company, everything will start looking better.
Okay, Mantesh, great to have you on the show. Thank you so much for taking the time out and joining in. Still under pressure, still not out of the woods, and still struggling at that 17,200 mark, 17,135 now for the Nifty spot. In fact, no recovery even for the global equity markets. I'm just going to refresh my screen and tell you what the Dow futures are, currently at. We're still just mildly in the green for the Dow futures. Although S&P as well as the Nasdaq, one must say, have definitely stabilized. But Europe, that's where the pain points are. It's a 2.5% slice down now for DAX. It's down 375 points, and this after a gap down start. It's only worsened from there. Over 2% down for CAC, and 130 points lower for the FTSE as well. FTSE MIB has cracked 900 points as we speak right now, and similar is the price action for stocks 600. Quick break. When we come back, the last lap of today's trade.
All right, S&P futures in red and Dow futures are in red. Indian market just no recovery whatsoever. Deepak Shanoy joins us now, and he's been busy over the weekend. Deepak, I read your Twitter handle.
Yes, it's been crazy times.
Are these crazy times? Because the problem in a sense now is getting arrested.
Well, it doesn't seem to be the markets, stock markets don't seem to think so, for one. But I think the bigger problem over here is, clarity on what happens to the rest of it. I think First Republic is another US bank which seems to have had to borrow a fair amount of liquidity at the Fed window, the new window that they've created. So there is some feeling that some of the smaller banks will have an issue and all that stuff. But I think over the next few days things should calm down. For the most part, I think the fears are out, are away, and we might, we should not see contagion from now on. But strange things happen to markets. So I'm at least at this point, at some level, a spectator only.
Investor, Deepak, aren't you like wanting to protect capital and book out from wherever you're sitting in the money?
To be honest, Aisha, this might not be the right time to do, this kind of selling and waiting for a crisis to hit us. Usually, at times like this is when you get opportunities to buy, and you want to, because if you're in the market for a month, then yes, there's too much volatility. This is not the time to invest and all that stuff. But if you're in the market for 5 years, already a lot of valuations have come down significantly, and now you're getting some stocks at very, very attractive prices. And we think that going forward, if the economy starts to rebound and do well, especially because India seems to be relatively more isolated from all these, these extreme movements in both interest rates and also extremely high inflation. I think that stability is going to do us well for the next 5 years. So I'm actually quite bullish for India as a whole. But the next 3 months, anything could happen. We hear the cricket commentary, all three results are possible, but that's what it is. And the next 3 months are going to be crazy. Next few months may be crazy, but I think, this is actually, this is a time to be bullish, not to be away from the market.
It's turning out to be a rather ugly session for sure. I mean, that is something which is evident. Naresh, you still maintain the view that we are weak, but it's not going to be a sharp fall. It's going to be a gentle grind. But do you think it's going to get closer to 16,000, 17,000, 16,800 or 16,500? Where do you think eventually we will go, Naresh?
So I'll go to the fact that what is the fear which is going on in the markets? SVB Bank collapsing brings down all the memories from 2008. So we saw the first action happening in bear stearns in 2008 March, and the index corrected for the next 2-3 sessions, and then we saw a 12 to 15% rally across the world, and then we saw the indices fall 50% over the next 6 months. So that is the fear which comes back to the market, and that is why we are seeing the same reaction. So the first action has taken place globally, and it's very difficult for the same thing to play out in the next crisis. So that's my view. And in terms of Indian indices, we are consolidating rather than falling off. So the view is we find some base around 16,800 to 17,100 mark, and I would be looking at an accumulation zone at 16,900 to 17,100. So I expect a bounce back from this zone, and say similarly a bounce back in global markets as well. Because when the first action takes place, that could generally create a short-term bounce. And given that it's a trade, and I would keep a stop loss at 16,750 and look for a buying opportunity in the next 5 to 6 sessions going into the Fed policy by 22nd March.
Seems to be in a bit of a hurry to even breach that 17,100 mark. We're down to 82 points right now, so pretty much at the day's lows. Kunal, what happens next if we were to breach 17,100, which seems like we're pretty close to?
No, I think these are just, I would say, more of technical or sentimental breakouts. But I think what's actually happened is that the back of this strong uptrend has been broken. So we were trying to look at it this way. We were trying to protect the 70,200, 300 mark for the last 1.5 2 months approximately. And once that level is broken, and on a day like today, where the expectation was that the markets would probably get into at least some kind of a recovery, if not into a strong positive closing. That generally dents the sentiment for the markets over the near to medium term. Now, the most interesting data which I am looking out for in the index is the massive rise in the shorting of Bank Nifty futures. Now, I was looking at the last 20-30 days of comparison. There was hardly any jump in the open interest. In fact, over the last 10-20 days, there was actually a reduction of open interest. Today, the addition in open interest is almost 20%. This is like a cumulative open interest which generally happens in a month. So today's traders typically have gone fresh shorts on the indices or maybe hedged their portfolio, and today's the first day we've seen that happening. So till the time today's high is not broken out on the upside, I think it's going to be a very difficult call to try and go contra even in this kind of a market. I think either traders should try and stay away from taking any long positions over here, or if possible, someone who has a high risk appetite should even look to go short.
Go short.
Yeah. Okay. So that's what our view has been.
I'm just saying, just confirming anything. And because going short is something which you've not heard this year. You've not heard this year. And that's the difference, that now the trade which was buy first, what was the trade, let's say, at the beginning of the year? You got to buy the market. And if markets fall, stay with the market, don't panic. And if markets fall more, buy more. Then the view was that, okay, this market is going to get jammed, so sell when you get uptick. But now the view clearly seems to be technically that you sell the market. No, you short the market. And there's a difference in sell and short. You own what you sell and you short what when you expect markets to go down. So there's a big change in terms of what Kunal seems to be indicating as a very basic approach. Deepak, from morning we've been discussing that why this is not 2008 and what are the similarities between 2008 and 2023. What are your thoughts?
So, I mean, as much as I've seen, I went through 2008. I think 2008, actually, the crisis started in 2007 in July in the US, and, kind of exacerbated with bear stearns falling in January, and India correspondingly had a large IPO set of issues. and that coincided with the market fall in January, and then it moved on. Things were very different. If you remember 2007 and 2008, there was an extreme air of bullishness that preceded the fall. So the fall came as a kind of a surprise, saying, "Oh my God, is the economy not doing that well? Are these banks over leveraged and crazy?" Today we have an opposite scenario in the sense that people are actually very circumspect. They're very skeptical of any good news. There is 1.5 years of nothingness that has happened to the market, and there is a lot of fear around interest rates and inflation that continues to go. But the markets are relatively in a better shape. And domestic investors are continuing to invest. Foreign investors are selling, and there is a lot more fear today than there used to be before the markets cracked in 2008. I think so. It's a bit of a different phenomenon from then to now. And also, this time, the leverage in the banking system is not so much. There's leverage in other places, but not so much in the banking system. In fact, the Silicon Valley Bank collapse, or even the other banks that collapse, are not because of bad lending. It's just because of interest rates going up, which is not so bad a cause, because then you can rescue the bank in a much more controlled fashion. So I think in general, the feeling right now that I'm getting is people are too scared, and that's why they equate it to 2008, whereas the fundamentals and the dynamics are actually very different. We actually have far worse fundamentals than 2008. 2008, the economy was growing in India, at least, and even the US. Right now, things in the US and India are not growing quite as much. So the opportunity to grow from here is possibly higher if the interest rate cycle and inflation cycle turns, uh, which is a very different feeling from what it was in 2008.
Big difference, and that's the leverage level in my book. The leverage level of the balance sheets are different. The prop books of the banks are not there. A new act has been passed after 2008 where the scrutiny of the banking system by the regulator is very, very different. Markets does not, like Nuresh was saying, that market do not react to the same problem again and again because markets get used to it. And I remember as a market commentator in 2013-14 when the crisis happened in Greece, the word pigs was coined. And we don't talk about it today. I mean, that time from banks to countries, we've discussed that, okay, you know what, this is going to be a bigger crisis because you're talking about countries going bankrupt, and the word pigs was coined, and that is not been discussed now. So that's how memories are. We tend to overreact in the short term. We tend to underestimate the power of human resilience. I think the way central banks have acted, at least the way Fed has acted, they've not waited this time. Unlike the 2008 crisis, they waited for a lot of days and the collateral damage happened, and then they had to rescue the banks with the US tax holder money. In this case, today who's taking the haircut? Depositors are not taking the haircut. The haircut has been taken by equity owners, equity holders and bond holders. Those folks are paying for the misjudgment. True. See, if you made an investment, if you lose money, that's a risk which you've taken as an equity market investor, as a bond market investor. So you're entitled for the upside, but you have to also accept the downside.
Take the hit, yeah.
So I guess that is what is the differentiating factor, if you frankly ask me, that this time around the bailout is not by US taxpayer money, or it is not Fed which is coming out and giving credit to the banking system per se. All you don't want to see is that you don't want to see run on banks, some other banks. Then there is a problem.
Yeah, seems to be the case. Okay, by the way, Reliance is now at a 52-week low. The stock is struggling around 22.80 thereabouts. That's cracked hard. Infi, like we've pointed out, in any case, is down and out. The HDFC twins as well. I mean, to think of it, HDFC Bank was only about 2% away from its 52-week high and one of the best performers year to date. That rally also seems like it's going to get stalled. But Deepak, you were talking about as to how in this decline, you would use this as an opportunity to buy. But what do you buy? Do you buy more of the same, or are there newer names which you would be looking at?
So for newer names, Aisha, I think, we have results season coming up soon. So we might wait to, we've been buying some new names, but, we'll build real positions on them after results. But there is actually, look at, like, say, the USD INR, look at our bond yields. Those markets haven't, gotten destroyed or moved any meaningfully negative way against us. So I think on the whole, the economy seems to be in a far more stable state. So I would still say the shift now is to domestic manufacturing. The shift now is to some sectors which are going to disproportionately benefit. For instance, you got railways, you got defense, core infrastructure, capex. So I think these are cycles which will continue. Of course, interest rates are going up, so there may be a little delay to this, but eventually rates will come down as inflation will moderate. Today evening, inflation numbers come in. That might tell us more about how our economy, how our inflation numbers are, and later this week when the US numbers come in, I think how the world economy. So I think much about buying right now in terms of portfolios will be able to reposition yourself. I think some of the names that made a lot of money for us in the last decade, when interest rates were relatively low across the world, are probably not what's going to work in the next decade. So high PE, high quality company growing at 12, 13% is possibly not where you want to be, whereas a relatively low, less leveraged, but with some leverage, manufacturing company that has a very wide landscape will probably provide the growth in the next decade. So it'll be a small phase shift, but it's a phase shift that's important for portfolios.
No recovery whatsoever. Naresh, would you chance your arm to buy out of money calls?
So I would wait a little more because I don't like to preempt when there is a lot of announcements. But I would go stock specific. So the strategy to be in defensives has worked out well. So the PSE index is actually, none of the stocks have really fallen or actually gone up 5 to 10% over the last 2 weeks. So my view is the same. I would rather go buy a power grid at current levels or a ONGC than to chance an arm on the Nifty and the Bank Nifty.
What should markets expect in terms of a sequence of news flow? When the problem came, everybody was looking up to Fed in terms of a indication. They've stepped in, they protected the depositors. There is a Fed, so the Fed has done what essentially they wanted to do in terms of the rescue or the bailout package. But in terms of sequence of events now, what should markets monitor? What should markets be generally worried about? Deepak?
Oh, sorry, this is for me. Okay. I think monitoring from a monitoring perspective, two things. If there is a flight to safety in terms of people running out of equities and into bonds in a meaningful way, that might mean this downturn will last a little bit longer than we imagine. And otherwise, this current crisis is probably going to be over in a week if things are allowed to recover where they are. The other point is contagion. You want to see what's happened in the US is to a relatively smaller bank, although it's a very large bank, it's bigger than HDFC Bank, but it's to a small bank in comparison with the US thing, and it's a very relatively regional bank, only 150,000 customers in the bank and so on. If you look at Europe, their economics and the banking system is far more leveraged and has far worse quality of assets and has way lower governance standards than most of the US banks do. So I think if the contagion spreads there, then we're going to have a different kind of a market response. So that's something to monitor. In India, I think the point now is to look at annual reports and results as of April, which will give us a very good idea of how things have panned out in the last quarter. And if there will be a little bit of a slowdown in comparison with what used to be earlier, but I think we should get some really good commentary going forward, at least in terms of demand. We're not seeing industrial demand meaningfully down at all. And we're slowly starting to see a rural recovery. So I think I'm bullish there on those aspects. Monitoring wise, it's the next 3 months or 4 months where you got this high inflation, high interest rate, potential busts and defaults that are the cycle to watch for. And I would say in India, watch the NBFC sector. Cost of capital is going up quite tremendously, quite heavily, even within India for riskier credit. So anybody who's the risky end of credit is seeing 9 to 10% at least borrowing costs, which used to be 8.5% or 7.5 to 8.5 earlier. So they've seen a phase shift jump in their credit costs, and that means certain NBFCs will have trouble refinancing. Beyond that, I mean, I don't see a full-on crisis, but then I've been wrong before. Who sees a full-on crisis before it happens?
Right. Just looking at what's actually holding up in the market, it's not much really. There's Tech Mahindra, which continues to stand in its pole position. And then, of course, this Apollo Hospitals, Sun Pharma is resilient to some degree. Balrampur Chini, which is mildly in the green. And guess what? United Spirits is the one which is holding out. That's what people would need today, right?
No, Adani, if you frankly ask me, if you are looking at risk,
That's now drifted in the red, by the
no,
way.
it should have fallen much more. If the collateral damage for, I mean, you know that
But then
institutional
they've had
investors.
positive news flow as well coming out, right, over the weekend, or I think on Friday evening.
No, you
yeah,
know-
weekend.
Yeah, so there is a
The
rumor.
prepayment,
There's a rumor that there's a buzz rather that they are looking at two things: selling stake in Ambuja and repayment. I think was what the Economic Times today has reported that they've repaid debt. What? No, Aisha, the point is that how a group which triggered the market nervousness in the month of Jan and Feb today, at a time when nervousness is getting triggered across the world, is not falling. Why? Because you know that the buyers and the sellers now, there's a buyer in the town, and he's a big buyer in the town who's got a reasonable amount of appetite. So sentiment changes as the profile of the news changes. I'm just bringing a point out that today it's an anti-climax that you would have imagined in a weak market, this entire group should have got this, it should have been down by 5 to 7%, considering where they are. Adani Enterprises down 1%, yeah, I mean, now it's drifting lower. Naresh, does it make sense to revisit Adani group of stocks? The weak group of stocks today are becoming the strong group of stocks?
Not really. See, even in the good times, it was something to avoid, given that low float and say not much of an institution participation. The stock which still looks interesting would be Ambuja Cements. That's a stock where the new base should be 360. So you want to buy closer to that. So I think the opportunity in the whole group is in Ambuja Cements. That's a stock which can eventually go towards 420, 450. The rest of the names could stay sideways, and say if you want to participate in Adani Green, Adani Power, the problem is you can enter, but the exits are on lower circuits. Entry is on an upper circuit, which is difficult to get in also. So there is a lot of impact which is difficult to assess. So I would say if one wants to buy the Adani group, look at Ambuja Cements on declines from here.
Adani Group has fully prepaid the $2.15 billion share-backed financing ahead of deadline, and I guess that is what kept some of the stocks resilient up until this last-minute crack that you are seeing on those stocks. Okay, just minutes to go before we wind up for the day, so let's get in some BTST trades as well going. Kunal, what is it? STBT?
Yeah, ST.
Or ST? ST?
ST. Yeah, maybe ST could be a better word, but then sell today, sell tomorrow.
Sell tomorrow. Okay. Come on, Nikunj.
So two sell calls. The first one is a sell on BHEL, a stock which I had, I think, suggested a sell 2 or 3 days back. So would maintain the bearish stance on the stock. Targets revised to 72. Stop losses trailed to 76. So traders can look at initiating a fresh short even at current levels. The second would be a sell on L&T Finance. This is a fresh breakdown for the stock, breaking below the 50-day moving average, which has been a big support for the stock. So sell, targets of 82, stop loss at 88.
Right. Naresh, what about your BTST ideas or STST, whichever one you would pick and choose?
So it would be a buy and a sell. So it would be a buy on Power Grid, the defensive stock, which is still actually positive for the day by just 0.1%. The stock still looks interesting. Could see a move towards 230, 32 levels. A stop loss at 224. Second is a sell on Eicher Motors, which has given a fresh breakdown below that 3100 mark. Could see a slide towards 2900. A stop loss at 3070.
Where do you think, Deepak, this market has overreacted and you're just waiting for a bit of a turn, maybe a couple of days, and you want to be a buyer? I mean, you've identified that name, that group, or that idea.
Yeah, I mean, we're still buying some, so not taking any names right now, but we're shifting a little more into some companies in the engineering space, which are primarily either supporting manufacturers or are primary manufacturers themselves. There is value here. I mean, these are companies now with 10 to 15 times earnings kind of valuations, relatively smaller caps. We're also seeing some value in the extreme large caps. I've been a LIC buyer for a long time. I continue to be buying that stock. I think big positive surprises come in the last quarter as well, and some more clarity on a few things that I believe will come. Also, if you look at the market as a whole, there are a lot of players which haven't moved for 1.5 years, whether it is HDFC Bank or whether it is Reliance or a bunch of these guys. There is a, I think the fact that they are not breaking down substantially below where they used to be and also not breaking out gives them the ability to have made their earnings a lot better and their book a lot more resilient in the last 1.5 years. So if I were to say, building positions, I think you'll have to build a combination of these positions, some extreme growth, some just that good stocks that have just come into territory where price is reasonable. But next 3 months, think of anything you buy as 30% down the minute you buy it. This is one of those markets. Uh, but I think it's better to be a buyer if you're in a 5-year zone than to be a seller.
Okay, fair point, Deepak. But what is it that you would steer clear of right now? Let's put it that way. Not sell, but avoid.
So I think some of these, so the companies that, for instance, I told you, Asha, the companies in the quality space where we're looking at 10 to 14% growth at best, but earnings multiples are 80 times and 90 times, ROCE of 25, 30, 35%. The ROCE won't matter now when the growth metrics are more important because you have to grow to beat inflation and interest rates. You're not going to be able to get this kind of PE valuation anymore. I think that is where you're going to suffer a little bit. If you're paying high PE, make sure you're paying it for high growth. That's where I think the avoidance part of the market will be. There's lots of them, of course. I won't name because it's unnecessary, but I think rejigging your portfolio to reduce the ones that are good companies but very high PE, not likely to grow very much in the next 4 or 5 years, to companies that relatively have a better risk reward in this equation. I think that's the phase shift. Again, not I won't say that these are bad companies. It's just that the prices are not good enough, and there are better prices available today. I would downright avoid highly leveraged companies, highly leveraged NBFCs who are dealing in unsecured credit, some of the microfinanciers, because right now the input costs and the default potential is substantially higher than it was 6 months ago. And I just want to steer clear of trouble here.
75 points higher for the Nifty. No. When higher, I say from the day's low. No, Deepak, don't look at the screen. I'm completing my sentence. I was hoping for that reaction.
Recovery from
the day's low. 75 points higher from the day's low, recovery from the day's low. So you will just close here or there. The fact that 17,200 is broken, it just shakes the market. So what happens, Kunal, if in next 2 days the 17,300, 17,350 is regained?
No. So as I said, it doesn't count because till the time today's high is not broken out, we should not be ideally taking any long positions because there would be counter rallies. There would be false rallies in between for the markets whenever we go into an oversold kind of a price action. And post that is where the trend starts off. So the breaking of 17,200 is an indication of a new trend which has begun. So between a trend, there would be, of course, counter rallies, which could be very much possible.
Okay, now 2 follow-up questions. In your assessment, if this is a new trend, every new trend in a sense has a quantum which you would say scale. So in the scale of 1 to 5, how convinced are you about this downtrend?
I am pretty much convinced. So I'm not sure what is 1 and what is 5. If 5 is the highest, then
obviously,
yeah.
So, ulta kaun khelta hai?
Short mein ulta hi.
Why number one conviction?
Okay, let me define it again. 1 to 5, 1 being lowest, 5 being highest.
I think I'll be closer to 4 and 5.
Okay. What will force you to change your view? What is that level of mark?
So 17,550, which was a gap, 580. So maybe 17,600 approximately.
Okay. Nuresh? Okay, 1 minute left. Nuresh, I'm going to wrap the market and then get this question out from you. We are about to close almost at the lowest point of the day. So that 20 points, 50 points, frankly, does not matter. That wall which we were talking about of 17,300, Lakshman Rekha wall, it's been broken. The breadth is just dented. And you've gone down when US markets did not fall. It was largely because of what happened in Europe. And now there is a fear of contagion which clearly seems to be there because European banks are down. Financial stocks across the globe have taken a hit. While we can argue back and say regulators have have stepped in, and the fear of contagion is not going to be there. But the levels of the leverage and the interest rate hike in the world is so steep that the casualty rarely stops at just 1%. Bitcoin would be the interesting one. We just mark the Bitcoin right now because Bitcoin in the morning had rallied 10%. I haven't checked Bitcoin after that. So it's a bad day. It's a poor day. In the morning when we started, it appeared that the worst is behind us.
Bitcoin, Ethereum up 9%.
So dollar index is down and Bitcoin is up. Is it one of those days where it just pure technical pressure for the equity market? I don't know. All I'm saying is that it's not that bad and that scary as the news and the macros, and if I look at other assets also. See, by now Bitcoin should have gone down and dollar index would have spiked up. Or for example, something would have happened to the global volatility index, which is also not gone up. So I'm hopeful that we go back to a day of sanity, provided we don't see any more casualties in next 24 hours or next 48 hours.
Okay, but can't negate what has happened today. It's been a rough start to this trading week. We'll wind it up right here and we'll see you again with all the market action tomorrow morning.